Hi, my name is Darren Joseph from HCJ.tax, a team that demystifies that sometimes confusing world of international tax. And HCJ.tax is a part of Moore's role in Asia Pacific, which has over 30 offices as far north as Tokyo and Beijing, all the way down to Auckland, New Zealand, and all the way across to the Gulf states, including Bahrain and the United Arab Emirates. So what I want to do now is share a clip from a recent Zoom webinar that we did as part of MARP. Take a look. The conversation was kind of evolving. Well, the different offshore centers, how are they ranked? How are they evaluated? That kind of became the genesis of this informal chat today. So without further ado, I think we could just jump in. Over to you, Aaron.
Thank you, Darren, for that introduction. And yes, that's right. We sort of started with a discussion on WhatsApp, which expanded very quickly. And there are a myriad of tax havens all over the world with different upsides and downsides. And in fact, it would be impossible in a 1-hour session to cover even a slither of the options around. But I'll give you my take on what I believe some of the best options, and more importantly, in my view, what to avoid, because it's just as important to know where not to go. I'm not going to cover Lubion and all those sorts of things because you guys know more about those structures than I. Before we get into that, I just want to cover off some context because I think that's important as part of the discussion. After 35 years of doing this international tax stuff, I've come to the absolute conclusion that tax should never be the driver of a structure. It is the outcome of a structure, perhaps, but not the driver. And too often we have clients looking for the lowest possible tax option without considering the commercial issues that may bring with it. I'm not sure, it might not be the case in every country, but certainly in a good number of the countries, treating shopping is deemed to be automatically anti-avoidance. If you're looking to do a structure with a tax haven and looking for double tax agreements to support them, that is actually, in most jurisdictions, immediately anti-avoidance, and therefore you're in a big, deep pile of you-know-what. Notwithstanding that, though, most of the OECD and certainly the British Commonwealth countries do follow the Westminster principle, which is you are entitled to restructure your fees in a way that does not mean you pay the most amount of tax. There is some latitude within that principle in order to structure your affairs, in order to have a good level of low tax. Not zero, but you don't have to choose a structure that gives you the highest amount of tax. Instead of the Westminster principle often appears in the New Zealand High Court and Court of Appeal as a defining principle to abide by. And the IRD often lose a case on the basis of the Westminster principle. However, and this is tax, as soon as you see a tainted tax haven in a structure, the New Zealand IRD, the Australian ATO, and a myriad of other worldwide tax jurisdictions will automatically put you into a tax audit and a continuous tax audit every couple of years. So if you want to go down this route, be aware of the extra costs and time that you will spend defending it over and over and over again. In New Zealand, as soon as you see Vanuatu, for example, they assume that the only commercial driver for Vanuatu is tax. And if tax is your only driver, therefore they will just strike it down. The ATO are far more aggressive than the New Zealand IRD on tax havens. Tax havens result in a full group audit every year. And Darren's probably more familiar with this than I am, although I am familiar enough with the new EU rules about what's called the blacklist, which keeps morphing and changing every year depending on who's been nice and who's not been nice, and whether they've been able to disclose their current positions or not. It changes from year to year, and some countries are on that list and you would think that's slightly awry, but it's a good list of things to avoid, particularly now as some of the EU countries are allowing you to send money in, but won't need you to take the money out. And there's not much point in having a tax haven where the money's stuck in a tax haven and you can't spend it. So just be very aware of the new restrictions that are coming through, particularly on some of the Caribbean countries, but not just the Caribbean countries, where the EU effectively is stopping you from doing business, adopted by more and more countries. So if you can't show to the tax authorities that you have a fixed place of business with staff and invoices and banking and doing something in that tax haven other than from sequestering funds away to save tax, then it will also get struck down time and time again. Before you even start to go down the route of which place, I think you've got to, again, set a context in terms of what's the most important factors to take into account and then make your selection. Rather than trying to say, should it be Vanuatu or Cook Islands or Isle of Man or Malta or Jersey or Netherland Antilles, need to consider quite often whether the place is politically stable at all and whether there's a long or short evidence of low corruption. And costs are a factor. There's no question that costs are a factor. You can get the same services for 10,000 US per annum as you can get for 50,000 US or 30,000 pounds, depending on where you want to go. So costs are a factor, in my opinion, if you want to use a tax haven. 10,000 a year gives you a very good tax haven general structure. The other issue is whether it's how able is that entity to change or morph as law changes, because law is not stable. The EU is going to continue to attack these, as is the US more and more, as is some of the Commonwealth countries. So you need to be able to change and have flexibility in the structure without that costing you a fortune, so that it can change with the changing landscape. And often I find with tax havens, there's these other little hidden costs. Suddenly you want to do a change or issue new shares or change something, and suddenly the fees become astronomical. So I always ask about the hidden costs first. And as I said, if you don't want to have a tax audit every year, you can't use one that's tainted with a tax haven label. So things like Netherland Antilles, for example, and the ones in the Caribbean particularly, have that tax haven label, and that just makes them subject to a tax audit every year. Now, I liked it. I like audits. They're fantastic fee revenue for my team, and we make a lot of money from tax audits, particularly where we pick up structures from other clients, other accountants who have used the tax haven, but they're not cheap. The IRD will chase them down to the nth degree because they just don't like them. They, as I say, they assume you only went there for tax. What's the options? Well, you knew what I was going to say before I said it, probably, for those of you who have known me for a while. In my opinion, still, the best option is the New Zealand Foreign Tax Exempt Trust. It is the most flexible. In a politically stable environment, it is the most cost-effective and has no tainted at all. So we have a number of these in place, and to date, touch wood, none of them have been subject to a tax audit because New Zealand does not have the taint of a tax haven. You still get the zero tax rate, and the New Zealand government is fully behind these. So you have government support and a good banking system at a zero tax rate. Nothing comes close. Cost to set up, 12 grand US. Annual cost per year, 10 grand US. So it's a very effective, cost-effective, flexible option. If New Zealand's just too far away, or that you'd never have to actually visit a tax haven, then I always go to Singapore. Anyone says Singapore, tax haven? It is. If you set up a Singapore company but don't have any business inside Singapore, the Singapore tax rules therefore are simply zero. So you get the same outcome, no audits, no tax tainting, no problems. Getting a bank account in Singapore for a company that's not operating in Singapore can be a little tricky, but now everyone's using e-wallets and all the electronic banking systems. So the issues that used to be a problem have gone away. I still have structures in Singapore going every couple of months. I tried to send 3 to Moore's Walden last month. They went and got one a bit cheaper, but they'll come back. What to avoid, in my opinion? Anything on the EU blacklist. There's plenty of options without having to go to the blacklist countries if you want to use a tax haven. There are plenty of exemptions on that list, so there's a number of options there if that's where you want to go. Look, I've had clients go to Dubai, come out of Dubai, go back into Dubai, come out of Dubai. It's actually quite expensive to set up a proper tax haven, a tax exempt entity in Dubai. And then you have to have a permanent employee, and then you have to have a permanent office, and before you know it, you're spending 50,000 US a year, and you haven't done anything yet. And it's also really difficult to change it or make changes to it. You effectively have to unwind it and start again. It's cheaper to do that than to make changes to it. So what I appreciate Dubai is an increasingly favourable option. I've had so many clients go in and come out within a couple of years because it's just A, too expensive, and too inflexible. For heaven's sakes, don't go to the Cook Islands. Right? Everyone knows, well, if you don't know, then everyone should know, that there is no anti-money laundering, counter-financing or terrorism laws in the Cook Islands at all. So if you want to traffic people, traffic drugs, traffic arms, go to Cook Islands. Do you really want to be in a place where that's the reputation? Do you want your clients setting up a trust in the Cook Islands when you know it's subject to huge government corruption and where you know that you're in bed with armed people and drug traffickers? I don't think so. So Cook Islands is only for those clients of yours that might be in the slightly unwelcome economies. I have used Vanuatu from time to time. You can fly from New Zealand to Vanuatu in 4 hours, but it's now under a serious question. The UN has basically said either you take our funding and lose your tax haven status, or don't take our funding and keep it. The problem for Vanuatu is about half of their economy comes from the UN and the other half comes from the tax haven status. So they keep trying to put it off, but the UN are making it now very clear. Pick one, and I think they'll have to pick the UN money over the tax haven. So if you set up there, you might have to unwind it before you've even got it going. And finally, look, I have used the Caribbean from time to time, but as I say, the hidden costs are the problem. The setup costs, not too bad. You can set them up for about 10 to 20,000 US. But the hidden cost when you want to make a change, outrageous in my opinion. And that is me in 10 minutes or less.
Right, Aaron. Appreciate you sharing experience and your insights.